Hey, it's Sasha Evdokov. Welcome to episode number 67 of Let's Talk Stocks. And this week's lesson is about stock market pops and direction changes. Now, we're really going to hone in on the current market. We haven't done a in-depth analysis on the market in quite a bit of time, and we're going to go ahead and do that here in this week's lesson. So if you've been watching the critical charts and those videos, I typically do a more in-depth analysis on those videos, 30, 40 minutes, sometimes 20 minutes, on the current market as it is. However, in the Let's Talk Stocks session on these Thursday sessions, I typically strive for more of a lesson, whether that's an inner game mental lesson about how you can personally improve, or an outer game, something to teach you about charts or the market itself. So that is typically what I focus on. But the majority of the time, a lot of it has to do with internal battles, internal focuses, and the inner game of trading, because the outer game of trading with the technical analysis, all that stuff, you'll pick that up over time. But it is more difficult, and from what most people struggle with, from what I've seen over the years, is those inner battles. So for this week, I really want to hone in on more of the outer game of trading and more about just the stock market pops and direction changes and what the market has been doing, because we did get a pop today of a good 31 or so points on the SPX, but the previous day we had about a 50-point drop on the S&P 500. So let's discuss some of these pops, how things move, what are you looking for in these direction changes, and how this really applies to the current market. So typically, as we take a look at the overall market, what I look at is a few things. You look at the S&P, and the S&P, you got the SPY, which shows you a better indication of volume than the S&P 500, just because it's traded a little bit more heavily. And the SPY is traded 1/10 of the SPX. So if you buy one share of SPX, it's like buying 10 shares of SPY. Then you also look at the RUT, R-U-T, the Russell 2000, and for that, the baby RUT is the IWM, which, again, the charts pretty much look identical. And again, it's 1/10 of the size. Then what I also check is the composite, and the market typically trades based on the composite. And I'm watching these composites because these are typically the leaders. And when I'm looking at these leaders, I look at how they move, how they react. And I also check the volume of the leaders, how they were moving for that day. So those leaders would be like Amazon, the Apples, the Netflixes, those kinds of things, the companies that people really want to get into at the current time. And they're typically the same companies week after week, month after month, but over a quarter or two, sometimes they get rotated. At one point, GoPro was the leader, but now it's in the dust. So sometimes it just depends where the money flow is. Where are people putting their money? And then, I'll scan the diamonds, which is the Dow Jones. So you could do that as well. But typically, this is for the general public, but most people, in terms of the professionals, look at the S&P, the RUT, the composite. Composite, here we go. That's really what you want to look at, and I put more emphasis, I guess, on the composite or the S&P, and then probably the Dow Jones. And I'll check the IWMs or the SPYs for the volume because they just trade heavily on that. So if I look at the IWM, today traded 69.1 million, whereas the RUT trade, well, you can't even pull it up on this. On this chart, you can't even pull it up. I'd have to go to my other screen to pull it up. But it's just a lot easier to see the SPY volume, 239.1, whereas the S&P is trading 749.4 thousand. So, less than 1 million shares on the SPX, whereas with the SPY, you can actually see more real-time volume, and it's a little bit better. More people trade it. So looking at the SPX, when I do the analysis, though, I will use the SPX typically, but I'll go to both to double check and confirm. So Looking at this chart on the current SPX chart, we'll look at the weekly chart. And when we look at the weekly chart, I'm going to share with you the analysis of the support and resistance based on a region or range, just due to confluence. We've talked about that the market over the last year has been moving and trending here sideways. So that has been the major move of that market. Right around August of 2014, we were at 1958, and right now we're at 1921 in the S&P. So we really have just been moving sideways. So if you're with me on this sideways move right now, you're noticing that there have been a few bounces at that support around the 1900 level. You had one in October of 2014. You had another one around August of 2015. Then you had another one around September, October of 2015. And you're getting one right now. So what's happening to the market, and what does this mean, and how am I looking at it, and how do I find these bounces? When is it going to bounce, and what am I looking for? So all these questions will be answered for you in this video to a base level, okay? I could probably talk multiple hours about this one topic alone, but as far as the base level, I'm going to discuss this support and resistance pops and direction changes right here at these swing points and levels. So rather than drawing lines on support and resistance, I'd like to do something a little bit more fundamental, and it is to draw a rectangle. And the reason draw a rectangle, and I think it's better oftentimes if you're just getting started in trading or you're a beginner, is because it allows you to not jump in too early or not get too anxious or excited in the trade and pull the trigger at the wrong time. Now, I still do it from time to time, and you still will continue to do it from time to time, because you're always looking for the lowest price to enter a stock long, and you're always looking at the highest price to sell it short. So here, what I'm going to do is draw a few rectangles at the support and resistance area. So now on the S&P, I have a 2150 to 2123 or 2120 a resistance level, and that basically is a 30-point spread. That means you got to give the S&P 500 about a 30-point spread of wiggle room in order for watching it for a clean breakout to the upside. So if I was to enter the S&P for a long trade, I would enter it right around here above the rectangle. So meaning if the rectangle high is 2140 and it goes down to 2120, I would enter it right around 2155. So that gives me another 10, 15 points beyond that rectangle that I just drew. Okay, so if I look at the downside here and I draw a rectangle, now these things won't be perfect and they won't line up, but you can see how they kind of touch and line up. So here we're hitting some points. And this rectangle on the support level, I have a 1920, let's say 1930. I'm going to draw it a little bigger. So we're going to have a 1930 all the way down to about a 1895 level. So that's a huge support region. And the reason it's huge is because when things sell off, they typically will go violently. And that's why you will see certain prices, similar to back here in October of 2014, continue to go past it. And it went past it to 1823, 1820, and then pop. And then you get violent pops. You have the same thing that happened here on August 28th, 2015. We go down to 1866, but then we pop and hang out right around that 1920 level. So this rectangle really holds a lot of substance to our bounces. And this is what you're watching for when you're looking for a potential bounce. And the way I drew this is by finding swing points, resistance points, and where is the stock really being held up at, or the equity being held up at the most points possible with the most volume as possible. It's basically a change in direction. Now, if we go into, let's say, a 2-day or a 1 day, you'll start seeing this unfold a lot more, and you'll start seeing these change in directions. And the rest of this noise is static. So to simplify things, if you're a longer term trader, you basically want to only enter the S&P based on this chart right here above this region would be 2155, because our area is 2140 to 2115. Or if you're looking to short it, you want to wait till right around the underbelly of this rectangle, which would be right around 1862, 1865. You could wait to 1850. If you really want to play it safe, you wait until this clears right here on the swing points that were hit in the 2014 level, which was, what was that? 1820. So you would wait till about 1805. Now that's a large spread, but that means if that clears, you're basically looking for a very nasty market sell-off, and a nasty market sell-off could take it down to about 1560. So that's about a 400 point drop from where it is right around now. So if you're waiting till about 1820, that'll still give you about 300 points to the downside, even 200 points, which is quite substantial. So getting back to the pops and direction changes, once I've identified the region or the range in the market of where it's been bouncing, where it's been holding up, I start looking at the action that previously happened. So if we break apart the most recent action of the last few days, I look at the speed that the market has been trending lower, or where it's been going and how fast it's been going. And we've been moving lower really quickly, especially after that 1st of January. And we've talked about that market being toppy. We've talked about it just moving sideways, not doing much. And, I still think it's toppy relative to where it is. But for the short term, we are oversold, or we were oversold. So when I look at the market coming off the 2,080 point S&P and then selling off for, what do we sell off for? 190 points. Okay, we sold off for 190 points and now we bounced for 32 points. Understand and remember that what I always like to say is that 1 day does not make a trend. So when we have these bounces, just like we had a 150 point sell-off all the way till January 8th, 2016 here. And then we had a pop on that Monday for, it was just a green bar. It wasn't really a major pop. It was 10 points. It was consolidation. And then another 25 points on Tuesday here on January 12th. Then we had a major sell-off. That was just consolidation of about 50, 60 points on Wednesday. And now today, Thursday, January 14th, 2016, we had a pop of 32 points. We really had a pop of about 40 points, but then a slight pullback. So does this tell me that there's going to be a major change in the market conditions? Does this 1 day change everything for me? No, not necessarily. All it's telling me is that we could have another pop similar to what we had in September, October, and then we had a sell-off again further. Now, this upward pop in September of 2015 that we had lasted about a whole month. So we could have it coming back to the 2,000 level on the S&P, and then we could have it reject prices. Okay, we could have it come up and then reject it. Okay. So that's possible for the S&P to come up to 2,000 and then reject it. Now, keep in mind, the more frequently and the more often that we keep pounding at these bottom levels right here, the more often we keep pounding once, twice, 3 times, 4 times, 5 times, the more we keep pounding on it, it's like a drill going into a piece of wood multiple times, or a jackhammer going into a roof, or think of something pounding, a hammer pounding from the second floor down below. The more pounding you do, the more likely it's going to break. And the same thing goes to the upside. So if we're pounding to the upside, let's talk about this 2100 level that we were trading before. The more we were pounding here at this level, the more likely we were to break higher. Now, if we can't break higher or we can't break lower, if we can't get past those resistance or support points, then things unfold and it's building. This is building cause. When we move sideways for so long and we don't get through, it builds cause for one direction or the other. Now, in August, September of 2015, that cause was to the downside. Now, again, for the 2100 level that we were doing in November, December, again, cause to the downside. We weren't ready. If you were going to go long this market, I would wait till 2150. Otherwise, if we get back above the 2000 level, you need to see a nice sideways move for about a year or two, a few years to digest that move. Because the move, when we bring it back from 2009, had a 1,400 point move to the upside. So you need a pullback for things to be healthy, for things to be normal. So here, let's backtrack a little bit. So when I'm looking for when are things going to pop, I always assume that a swing point that has been hit multiple times, such as a support or resistance line, I always take profits into those areas, and I always assume it's going to go in the other direction because it can do it multiple times. And the reason I assume that is because it allows me to take my profits. So for those of you that have been following me, and we talked about this 2000 level on the S&P breaking to go short, I told you I was adding to the short side. And then what did we get that last few days? Those days, just yesterday, what did we get? We got right here a 40, 50 point more move. Also, from that 2000s, and just review the episode 66, I was talking about being heavily short right there. And we gained 60 points there. We popped a little bit higher. That's an opportunity to add to the short. And then you add to the short and you take some profits into strength. And did I give some back today? Absolutely. Yeah, absolutely. You lose some on these pops and you get out, but you're already taking profits as these stocks continue to move lower. Review the risk episode. I believe that's episode 65 or 64. So go ahead, review that risk management, money management episode right around that time frame. Review it because when the stock is moving in your favor, you take some profits and then you're out most of your position and you're still holding on a little bit because I know that these one-day pops most of the time do not last because I look at the bigger picture. But do I prepare for them? Absolutely. Absolutely. You prepare for them, and will you give some back? Absolutely. But I'm also getting ready and preparing for when this region breaks, because this is kind of no man's land. The region between this 1910 level that we had this bar or box on, 1925 to the 1880 level, it's kind of no man's land. But when we break that, when we break lower to the downside, then you see a huge open space to go another 200 points lower. So until that time, you're trading extra cautiously when you're in that range. So that's how I approach it. So I'm always expecting a pop and direction change. And that's why I'll still keep some shares short at this point, because I understand that we can get up to this 2000 level and roll back over. So we may pop to the 2000 and roll back over. So I'll still keep some shares short for a longer period of time until that point. However, what I also do is I will go long, maybe, let's just say you're short on the S&P and you're short, let's say 100 shares to make numbers easy. And then you took profits into strength right around this 1900 level. of 50 shares. So now you have 50 shares remaining. What you may do is trade the Russell or the IWM or the SPY. So you trade something similar. And what you may do is you're getting ready for a bounce. And when you see that bounce on that day or the day before, depending on how the market ends, the day before, what you do, or the day of, once you see the direction rolling over, you may trade 30 or 40 shares to the upside in like the SPY. Whereas S&P, SPX, if you have 5 shares, right, because that would be 50 SPY. So if you have 5 shares in the S&P, you may go ahead and do SPY, and you might trade just half of that to the upside. Okay, you could do the same thing with the IWM or the RUT. You could even trade these because they all kind of move together. They're not all exactly. So if you want to do the exact same one, then I would trade the SPY. And that's the beauty behind trading these large traded ETFs and indices. Not to mention you get a huge 60-40 tax break on those, by the way. You can check with your accountant on those kinds of things on the taxes. I'm not an expert on the taxes. But you get to trade the SPX, and then, so let's just say you're trading 5 shares here, then that would be 50 on the SPY. You might trade 20 or 30 to the upside and just hold them for a week. If it pops for a few days, then you're holding it as a hedge. That's what hedging is all about. And then if you see it roll over with weakness, you see it rolling over, you get rid of those SPY shares and you keep your SPX shares. Okay, so it's all about being prepared for the move. And it's all about learning the regions and giving these regions. And the tighter that you have these regions, like if you have a really tight, thin region where it's hitting it perfectly, you know everybody's watching those. Then you need to be extra careful. And some things just are perfect setups like that. Other times when the market's nasty or acting volatile like it was here at this 1900 level, which is the 1925 to the 1875 level, you have to be extra careful because they'll whipsaw at any given time because you have this pop or direction change that you're planning and expecting for. Okay, so hopefully this gives you some insight to these direction changes. Now let's look at the overall market conditions and where they're at and what do I expect to happen on the S&P, and this goes along with the SPY, it goes along with the RUT or IWM, all those kinds of things. So what do I expect to happen? We were oversold at this level, whether it's a correction, whether it's a pullback, the terminology definition is irrelevant, okay? What's happening is more important. So when we look at the market, at the 1880, 1920, 25 level, I'm watching what's going on and what's happening. I watch the volume. Those of you who've been with me, you know I watch the volume. And this can be a little bit confusing here, what's going on, what's happening here on this bounce. So previously, we traded 221 million shares to the downside of volume. Today, we traded 240 million shares to the upside. Okay, this is on the spiders. On the S&P, you had 1.2 million to the downside yesterday, which was Wednesday, and today you had 1.3 to the upside. So 1.2 versus 1.3 today. You had more volume, which is what you want to see from a bounce, but there is one thing you want to also watch. Okay, you want to see, does the previous price or does that same price region actually break the last price? And the fact is even though we had more trades going off, we didn't actually break the previous day's bar on the price. The price value was weaker, meaning you had volume, but you didn't have the price. You didn't have the price. And when you don't have the price, that means there's less things in your favor. If this bounce today instead of bouncing from here on the lows of 1878 all the way to 1934, if it bounced to 1960 and it finished at 1960 and above that, then I would say, yeah, we got some volume. We got volume, we got price. Yeah, things could hold up better if I saw higher prices. However, because we saw a pop and it ended kind of in the middle of yesterday's major sell-off, and you got to remember, out of the last, how many days did we have? Out of the last 15 days, we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 trading days, and we have basically 4 bars that are ending green, and 2 to 3 of those are basically sideways action bars, and then we have one bar to the upside. One bar doesn't make a trend. So should you be happy going in all in for your stock, for your trades? I would not recommend it. I would be patient and watch for a second or third day to confirm the move. And the problem with this on this little trend here, by the time you hit the second or third day, you're going to see how it reacts at this 2000 level. And once it gets to this 2000 level, there's a few things that can happen. And we discussed this back in October on these Let's Talk Stocks and Rapid Recap sessions, that if we get back above it, we can do a few things. Again, we can move sideways for quite some time, which is what we should probably do. We can move sideways and then break out. We can move sideways and break back down. Or if we break above that 2000 level, right over here, the same thing in today's market, we could continue and break past the 2100 level. But if we do that, that means everything is phenomenal and fantastic, and the stock is overextended. The market would be overextended. And then I would look for a very major sell-off if we broke the 2200 price level in the S&P, because that's very dangerous. Or the other option is we get to the 2000 level and sell back off, and then we'll see if this 1900 level holds again. So we're trading in this region and range, and you're playing those ranges for the pops, for the bounces, and what's going on. Now, until today, most of the volume until today has always been showing me weakness. We've been showing weakness all the way since December, and we've been showing that things have been weak and the market's been toppy. And until today, the market hasn't really shown some strength. Now, today's bounce did show me a little bit of strength. Now, I don't know what the exact root cause of this is, because we can never pinpoint that. There's multiple causes and effects. Some say that it's oil, like Marathon Oil, but these oil companies like ExxonMobil, like Marathon Oil, all these companies, they are not the direct cause and effect of one thing. Okay, it's like gold back, in the 80s and 90s that people discuss and talk about. It's not one thing that causes markets move and react. There's a funny little phrase or headline that says, 1 week the newspaper would say stock market is heading higher due to oil prices rising. The other headline next week, stock market heading higher due to oil prices tumbling. So in this situation here, we got a little pop in oil here previously right there, but look at the August of 2015, and you can see we were actually at much lower prices. So was there a bottom? Was there a bottom in oil prices? I wouldn't say so, because a bottom to me is it comes down and then it pops and then it's above it. Right now what's happening is actually since August we've been consolidating in oil. So actually what we've been doing is going sideways. And this sideways action, what happens when things come up to a certain level. These stocks, what they can do is come back up and then reject it again, because there's so much overhead supply. And this happens with just like Marathon Oil, when these things will, right now it's trading at 907. If it comes back up to $13.78, $14, it'll come back up, and it has a high potential to reject it. These things do not last just 1 or 2 days. These things typically last for weeks or months. We started that sell-off in these oil companies for at least Marathon Oil in September of 2014. Okay, so we started in September of 2014, and this was in the ABCD pattern. Those of you that have took the courses, you know this, you saw this, you knew this was coming. Voila. Now, what's happening now? We got another potential. That's right. That's right. Okay, think about that for a minute. Okay, and it happens in all the stocks you look at. If you can't find it, an ABCD pattern in the stock that you're watching, move on to another stock. Okay? It doesn't matter what company it is. Okay? Now, sometimes you will have some ABCD patterns that are a little bit harder to tell, and this one's really moving, okay? But in reality, they're there when you watch for them, okay? And what's fascinating is if we're looking at Twitter here, from the highs, here's a 42-point sell-off. Then when we go to the A to B, it's a 42-point. The pop on the B to C is 21 points, and then here, we're 31 points. 42 points would bring us down to about $9. Okay, so if you get Twitter at $9, that's where you can start nibbling some shares if it starts bouncing. So, looking at these market pops, direction changes, you're looking at these areas. You're looking at the weakness. You're looking at the strength. You're looking at what's going on, what's happening underneath. And right now, even though we have a little bit of volume coming in, one day does not make a trend. Watch for a second day, watch for a third day, watch for a fourth day, and see how things react on those things. If they're moving higher, but they're moving higher weekly, meaning in a weak fashion, they're not powering higher with strength, then that's going to tell you that things are going to roll over. If you don't see 30, 40-point pops, 20, 30, 40-point pops in the S&P over the next few days or the next week, then that's going to tell you things are weak. If you see a 5-point pop tomorrow and you see another 3-point pop the next day or another 5-point pop, that's weak. Okay, what you want to see, if you want to see a full change in direction, 20, 30-point pop in the S&P, maybe 50-point pop. Look at the, when we look at August 26, 2015, that pop of that day for the S&P was a 65, 67-point pop. The next day, we had 44-point pop. And even then, we had a rollover for 2 days of 72 points. And then another 113-point rollover. So it still took time, at least a month, to consolidate. Will things be the same? No, things are always a little bit different, but they still play a huge role in decision making. They still play a huge role. People are going to be watching that 2,000 level. That's going to be really critical because we broke it and we had resistance there. So pay close attention. And when you're watching these bounces, watch the next few days, how things move, how things react, how they're moving on that bounce. And today we had a little bit of strength. Would I go long this market? No. I'm still more heavy short, but I have some long positions for a smaller time frame, meaning I have temporarily long positions which I will sell within a day or two or maybe 4 days, or I could hold them for a month. And then I'm waiting for the market to roll back over. So I may hold these long positions for the upside for a few weeks, for a few months. And then when I see it rolling back over, then I let go of those positions and I let my shorts kick back in. So it's basically a way to not lose money for my main term play, because you remember I was putting in short positions at the 2,000 level. Now, if we break the 2,000 level and we get back above the 2,000 level, then what's my plan? Well, for me, what I'm going to do is I'll cash in those longer positions for the long side where you make the profit, And if I see huge strength coming in, then I will get out of my short positions, or maybe get out half, depending on how things moving. Or I could add more to my long positions for the temporary move. Okay, so it just depends how we come in to the 2000 level. If we break it very weak, then I probably will not add to the long side. If we break it with strength, I may add more to the long side, but still hold on to some short positions for the longer term. So you have to have your plan in mind for a few different situations before you even take that trade. So have a plan in mind before that stock gets there. And if these things roll over to the 1861, I'm out. I'm cashing out of my long positions. I'll take that as a loss. Then I still have my short positions, and I'm going to add to the short side. I mean, so you have to have a plan for where you're going to execute your trade and what you're going to do. If you don't have a plan, then you're going to be, one of those people that sends an email or wondering, oh, what's the market doing? What is this stock going to do? I'm in, 20,000 shares of this company, but it keeps, selling off. I just don't know what to do. I'm at a $300,000 loss. And I get those emails. But that to me tells me you didn't have a plan, or you were trading too large for your account. All right, hopefully this gave you some insight on the pops, on how things bounce. We didn't get into full detail of looking at exactly the bars on the intradays and things like that, but it's just a little bit of a taste of how to really look at these regions rather than just looking at the lines of the market. You're looking for these pivot areas rather than pivot lines for a direction change. And as you start getting into those levels, you're taking profits into strength. So if you're in a long trade right now and you're getting into the 2000 level, if we get there next week or in a few days, then you'll take half of your position off, or you'll take maybe 70-80% of your position off and see if it breaks higher. And if it breaks higher with strength, maybe you'll add to that again. But if it gets there and it starts rolling over, then you should be out of your full position and just cash in your position for the long side, whatever profits you made. So always have that plan in mind, because these stocks, they like testing these levels multiple times on multiple occasions. And right here on this chart, between 2014 and 2015, we hit this 1900 1870 level on the S&P at least 1, 2, 3, 4, 5, 6 times here. And if you're looking at the day marks, you'll probably hit about 10, 12 times. So we've hit it multiple times, and the more times you hit it, the more of that base it builds. And once those things break the one way or the other, you could see serious trouble. So, if it breaks to the downside, you could see some major trouble. If it holds up here, it's just holding. It still needs to base for a while. I would say I wouldn't even go long this market until it's past 2151, which is, not that far from here, but why trade in the sideways market? It's still 200 points away from that range, but why would you trade until that point? Because if you're looking for a further upside, the upside is unlimited. Whereas if you're trying to trade within this 150 points, it makes it much more difficult to find those lows and highs. So be patient, wait for the setups, have a plan in mind for a few different situations, so that way you can trade properly based on your account, your style, your risk management and systems strategy. So have that plan in mind. And when you do, you trade a lot less with emotions. You trade more systematically. You trade more focused. You're more disciplined on what's going on with your trades, with your account, with your stocks. And you start taking many things, looking at things a lot differently than when you were just a beginner or just getting started in the market. All right, so thanks for joining me. Thanks for sticking with me. Hope you had a great week so far, and you have a wonderful weekend ahead, a long weekend ahead. We're actually going to go do some painting this weekend. It's one of those get-togethers where you get to paint a lesson and just get some creativity going. So spend some quality time. Markets should be closed there on Monday. At least the NYSE is closed on Monday. I don't know if you're international trading, then they may not be. But for us, have a nice holiday break and, enjoy the weekend. Make the most of it. If you're in the snowy area, go play in the snow. If you're in the more warmer area, go enjoy the beaches and enjoy the activities around you. And, make the most of your surroundings. So thanks again for joining me. Remember, do what you love, contribute to other people around you, but most importantly, go out and live life abundantly because life is short. All right, thanks again, and I'll see you next week.